The first time you save $10,000 in your bank account, you'll feel this sense of relief because you finally have some financial breathing room. But then you get hit with the next question. What do you do with this money? Yahoo Finance just published this article on 3 smart things that you should do when your account hits $10,000, which are number 1, earn interest on your savings, number 2, pay off your high interest debts, and number 3, invest. Which I gotta say are pretty spot on with what I would say, but let's go a little bit deeper. By the way, if you want to read the article for yourself, I'll link it for you down in the description. So let's start with number 1, how do you earn some interest on this $10,000? Because according to the article, the average savings account in America is paying around 0.46% a year in interest. Which means if you save $10,000 into one of these bank accounts paying 0.46%, after 12 months, your $10,000 would grow to $10,046, which really isn't that much interest. However, at the time of me recording this video, you have a lot of high yield savings accounts that are paying much closer to around that 5% a year in interest. Now, this is where numbers start to look a little bit different, because now after 1 year, your $10,000 would grow to $10,500. But I have a little bit of bad news, because we all know that the Federal Reserve Bank is talking about cutting interest rates soon. And if the Federal Reserve Bank starts cutting interest rates, well, the interest rate that you get on these high yield savings accounts, even your regular savings account, are going to get slashed depending on how aggressively and how often the Federal Reserve Bank starts cutting interest rates. So if you're wondering if there are ways for you to continue earning some interest on your savings, you do have a few options. Number 1, well, if you have a high yield savings account, understand that it's not going to go from 5% down to 0.46%. If the Federal Reserve Bank cuts interest rates only 1 or 2 or 3 times. Yes, it will probably drop from the 5%, but it'll still be higher than the average bank account. Number 2 is if you really want to earn this type of interest from a bank, you could also potentially consider locking in a CD, a certificate of deposit, at a bank before the Federal Reserve Bank starts cutting interest rates, because that's a way for you to lock in a potential interest rate return. So if you see a bank offering a 5.25 or 5.5% CD, you can lock that in for 12 months or 18 months or 24 months and get that guaranteed interest even if the Federal Reserve Bank starts cutting interest rates. Just understand that with the CD, you do have the risk because you can't pull your money out without a penalty. So I'm not a huge fan of CDs, but if that's something that you're interested in, just understand that that is an option for you as well. This brings us to the second thing that you can consider doing, which is paying off some of your high interest debts. If you have credit card debt, those payday loans or those buy now, pay later loans that you didn't pay off in time, I would definitely take some of that $10,000 for myself and pay off those high interest debts as fast as possible. I would want to have at least $2,000 in savings to protect me against an emergency to start with. But if I have that extra cash, I want to attack these high interest debts because take a look at this. The average credit card debt in America is $8,674. If you're subscribed to Market Briefs, my free financial newsletter, you might have heard about this, and this is a lot of money. And the average APR on that credit card debt is 24.92%. What that means is while most people are trying to grow their money by 8 or 9 or 10% a year in the stock market or in the real estate market, your credit card company is growing their money by almost 25% a year because they're lending you this money through that credit card. And you're the one that's paying all of that interest, all of those fees, all those profits. You're the one that's paying for those private jet trips for the credit card company when you're paying this interest. But just to have some fun, let's take a look at how expensive this debt and this APR really is. If you took $8,674 today and you invested it somewhere where you could get a guaranteed 24.92% return and you never invested another penny, because this is what your credit card company is doing, after 10 years, you would have just over $80,000 and you never invested more than this initial investment. If you just let that money sit there and compound and grow at the 24.92% in 20 years, you would have over $740,000 in your investment account. If you just let that money sit and compound for another 10 years, now you would have over $6.8 million in your investment account. And just for fun's sake, if you let this money sit there and compound for another 10 years, you would have more than $63 million in your account because you could grow the $8,000 by almost 25% a year. And remember, this is assuming that you never invested another penny again. This is the money that is making our credit card company rich, because the reality is more than half of Americans are carrying a credit card balance month after month, which means more than half of Americans with a credit card are paying this money to the credit card company, and that's what's making them rich while you stay poor. This is why if you have some extra cash, you can use that to pay this down. That way you can get out of this high interest debt as fast as possible. And for those of you that want to stay up to date on what's happening in the financial markets when it's happening, Market Briefs is a free financial newsletter that I created where every day my team is working to break down what's happening in the economy, the stock market, the crypto market, the real estate market, and the global economy into a fun, witty, and easy to read newsletter. You can read it in less than 5 minutes every morning, and it's completely free, and I promise you, you are going to love reading Market Briefs. Now you might say, well, Jaspreet, how can you promise that? Well, if you don't love it, you can unsubscribe at any time because it's completely free. So if you have not joined Market Briefs yet, I got the link for you to join down in the description below. And this brings us to the third and probably the funnest thing that you can do with this extra $10,000, which is now investing this money. And yes, investing this money is better and more fun than spending it at Gucci. There are 6 different ways that you can start investing your money. Number 1 is you can consider investing in real estate. Number 2, stocks. Number 3, your own business. Number 4, into speculative assets. This is things like startups or cryptocurrency. Number 5 is physical gold or other precious metals. And number 6 is your own knowledge. When I talk about investing in real estate, generally this means you're going to go out and buy a property and rent it out to somebody else or to another business. But with $10,000, it's going to be extremely difficult for you to go out and buy a property. So instead, the alternative will be for you to go out and invest into some sort of crowdfunded deal, reinvesting or getting exposure to somebody else's real estate deal. This way, you don't have to worry about managing it and you're getting exposure to real estate. But you're not the one that's operating the deal yourself because you can't go out and buy a property with just $10,000. So if you want to invest in real estate or get exposure to real estate, look for some crowdfunded real estate deals. If you want to see some companies that allow you to do this, you can check out my affiliate down in the description to see what your opportunities are. Number 2 would be investing in stocks. The nice thing about investing in the stock market is you can get exposure to the economy. You can get exposure to individual companies like Apple or Amazon or Tesla or Lululemon. I'm not telling you what to invest in, just giving you examples. And you can start investing with as little as $10 or $1, and you get ownership into these companies, which means as these companies make more money, you can also make more money. You can make money if the stock price goes up. You can also make money if the company pays out a dividend, which is a cash payment that you get for doing nothing except owning the company. Now, not every company pays a dividend, but this is where you have that opportunity with stocks. And if you don't want to go out and invest in individual companies because you don't want to listen to earnings calls, you don't want to pay attention to the financial statements and do all that extra work, you can just invest in funds. There are ETFs or index funds or mutual funds that can give you exposure to the total stock market. There are funds that can give you exposure to the S&P 500, which is a group of the 500 largest companies in the stock market. There are funds that can give you exposure to the NASDAQ, to the Dow Jones, to healthcare companies, to AI companies, to international companies, to emerging market companies. There are funds that can give you exposure to whatever you want, and you don't have to worry about doing all the individual research. It can be much more passive, but of course the risk with stocks is you see a lot of market fluctuation. Markets can go up and they can go down very quickly. There's a lot of emotions involved in it, and if you cannot control those emotions, you might be the person that's making somebody else rich because you keep selling off your investments at a huge loss while somebody else is buying these investments at a discounted price. Third is you can invest your money into your own business. Now, if you have a business idea, if you have a side hustle idea, you can invest it in yourself. You have the highest upside potential opportunity, but you also have the highest risk. Starting a business is tough, but there's no limit to what type of returns that you can have. I mean, in the stock market, you're trying to grow your money on average by 10% a year. The stock market on average has grown by around 10% a year over the last 50 to 70 years. When you invest your money into your own business, your $2,000 investment could be worth millions of dollars if you can grow your own business. But of course, your business could also go bankrupt. So that's the risk you have with your own business. When I talk about speculative investments, things like cryptocurrency or startups, personally, and I can't give financial advice because I'm just a random guy on YouTube. I don't recommend what I do to anybody else. You always got to do your own due diligence and understand that investing has risks. When I think about speculative investments, if I'm getting started in my investment journey, I would not worry about speculative investments until I've really built a portfolio here, because these 2 things have built more wealth than anything else over the last century in the United States. Really, these 3 things, but starting your own business is kind of a different category. And so if you're getting started on your investment journey, you don't have any stocks or real estate, ignore the speculative stuff until you build a portfolio of the proven stuff. Then you can get into the speculative stuff. By speculative, I mean you can make a lot of money very quickly, but you can also lose that money just as fast. When it comes to something like physical gold, I own physical gold. This is a small piece of my portfolio. It's about 2% of my total portfolio. But for me, physical gold is not an investment. I look at it kind of like a hard form of savings. To me, it is a form of insurance or a type of hard money. It is not a real investment because this gold is not doing anything. When I go out and invest in real estate, this real estate is providing value because somebody can live there. When I invest in stocks, well, this company is working to produce value. They're working to sell a product. They're working to increase their profits. It's producing some sort of value. When I own gold, it just sits in a drawer. It doesn't do anything. So for me, it's a form of saving some hard money. That's why it's a small piece of my portfolio. I call it kind of like the doomsday insurance, but it's just a way for me to save some hard money. Some people look at it as something else, but that's the way that I look at physical gold. And then you can also look at investing in your knowledge, which is very, 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 did I say very, very powerful, especially in the beginning part of your financial education journey, because now you can use this knowledge to, number one, invest your money smarter, get better returns, pay lower fees, and improve how much money that you have because you can grow your money, but you can also use this knowledge to increase how much money you make. So if you're working a job, this could mean getting a new certificate, that way you can work a new job. This could mean learning how to negotiate your salary. This could mean starting a new side hustle. This could mean starting a new business. This could be finding new ways to earn more money. This is very powerful. Now, there's a lot of ways to invest in your knowledge. And you gotta kind of work up the ladder here. Because I get it, spending $2,000 on a class online can seem very intimidating. So what I like to do, or what I say, is start with the basics. Start with free content on YouTube. Start with free content on podcast. Then as you start to learn some more and you find some new topics that you like, start to invest in some books. $20, $25. Start to read a few books on the topic. As you start to learn more, now you can start to buy some classes, $300, $2,000, $2,500, however much they might be. And if you want more, then you can consider investing in some coaching programs, which also cost more money. But you don't gotta go out and just start dishing out thousands of dollars that you don't have. Work up the ladder. Buy things that you can afford and start with free education. People assume that you gotta spend thousands of dollars to go to conferences when you don't have that money. Start with what's free. And after you have some more money, then start to invest more money. Once you have more money, then you can start to invest more money. But it's all a game. Invest in your knowledge, invest in the things that have been proven, and continue to grow that money, continue to grow your wealth, because the reality is, if you do smart things with your money today, in 10 years, your future self will thank you many times over. You are 25 years old right now. You go out and you put $8,000 down to get yourself a brand new BMW, because everybody's got a nice BMW nowadays. And now you got these expensive car payments that you're gonna be paying for the next number of years. Now, after 5 years you pay off the car and you might think that you're gonna be car payment free, but what ends up happening to everybody in this situation